In my youth, I learned that there are two fundamental forms of investment error. One is the error of omission, the other is the error of commission. Omission is money that you didn't lose, but you didn't make, and it doesn't matter. Errors of commission is where you put scratch up and lose it. Not making the money that the other guy made, but doing fine yourself. Those are errors of omission, and they don't matter. But putting $100,000 into something you don't understand and losing it, that's an error of commission. So the worst investment mistake that I can think of is fear of missing out or envy. The other thing is that sadly, Jake, people don't work hard enough. The theory of many young narrative-oriented speculators is far too often got a hunch, bet a bunch. Wrapping themselves around the narrative where they don't understand anything about the investment proposition that's in front of them. People focus slavishly on share prices without having an opinion as to value. I have been incorrectly quoted as saying that I don't believe don't believe that markets are manipulated. I believe that all markets are manipulated in the near term. I don't believe that there's been a decade-long conspiracy to reduce the gold price or reduce the silver price, although I believe that governments talk it down all the time, because expressed faith in gold and silver is the same as expressed lack of faith in government, which hurts governments' self-image. But markets are manipulated all the time. The idea that somebody would sell a very large amount of silver at midnight when there was nobody else in the market says that they're not trying to maximize the return on the silver that they sold, rather that they're using the price action in the physical market to spoof the paper market, which is on a daily basis. Did you know, Jake, many days, the futures market trades 200 times the available of silver for good delivery. I'm not talking about on a weekly basis or a monthly basis. I'm talking about on a daily basis. So the ability to send price signals to the futures market, which is extraordinarily leveraged from the physicals market, is huge. And the market gets manipulated a lot. But the manipulators manipulate in whichever direction is easiest. When I came into the market in the 70s, the manipulators were there in force, and they were manipulating the market higher. The spoofs that they were doing were the other way around. When interest rates were declining, and hence of that, the value of bonds was increasing, the desirability of precious metals to hedge the currency was depreciating. For 40 years, the trend in fiat currencies and bonds was higher, and the trend in physical metals was lower. They didn't need to manipulate the price of gold lower. It was doing it all by itself. Now, what I think you'll see as the price of precious metals trends for the next 4 or 5 years inexorably higher, the manipulation that you will see is in the other direction. Now, this is going to get me a lot of hate mail on your site, but that's okay. The way the trade works right now is you look at the futures market, you establish a short position in maybe the 120-day, maybe the 12-month, and maybe the 2-year. You leverage that position, pretty extravagantly, which they're able to do. You borrow $50 million worth of silver, if you're some big bank or country or something, and that'll be nameless. You wait till there's nobody in the silver market. You pump the silver that you borrowed into the market, and you knock the market off 4.5%. You are leveraged, on margin 10 to 1 in the futures market. You knock that price down by 5%, you scoop in the very near term 150, 200% of capital employed. You chuckle, walk off, and wait, and do it again. In the future, that trade will be done backwards. Rather than going short in the futures market, you go long in the futures market. Rather than borrowing $50 million and dumping it in the physicals market, you borrow $50 million and go long overnight in the physicals market. In other words, getting the worst possible price on the buy side that you could for your silver, and come off your leveraged long positions in the futures market. Precisely what happened in the 70s. It's what the Hunts tried to do writ large. The Hunts figured out that the above ground silver in system available for delivery wouldn't compensate the demand, so they set about to corner it. I don't want to get deep in the words. In my heart of hearts, and I hope you don't use this as a headline or clickbait, in my heart of hearts, it wouldn't surprise me at all to see low triple-digit silver prices. I don't consider my prejudice to be an investment fundamental, which is to say, I don't have the confidence that Eric Sprott does to make the simple declarative statement that your viewers like so much. Eric is a speculator, and I'm a loan shark. We have very, very, very different outlooks on life. I believe that the value, the purchasing power of the dollar goes down, and that assets denominated in value in dollars goes up. I believe, too, that instruments that are viewed by people as stores of value will become more valuable and highly coveted. We've discussed on your show before, Jake, the fact that the market share of precious metals and precious metals related assets in the United States is less than 0.5%. The 3 or 4 decade mean is between 1.5% and 2%. Gold and silver don't have to win the war against US dollar. They just need to lose it less badly. If demand for precious metals and precious metals related assets merely returned to the 3 or 4 decade median or mean, demand for that asset class would somewhere between triple and quadruple in the largest savings and investment market in the world. I can't tell you, because I don't know, where the silver price would go if demand for it quadrupled. But I can tell you that if demand for it quadrupled, that the number would be much higher rather than the same or lower. Eric and Keith can give your audiences answers that are more satisfying. I can give your audience answers that are more rational and true. The most attractive commodity to me, price, risk versus reward, is uranium. In the very near term, the uranium stocks are way overbought. So I don't want people to hear me say that and go out and buy uranium stocks that have tripled in 3 months. That's not what I want.
Got it.
In the near term, the most attractive asset to me is cash, because I think that we're going to run into volatility. And despite the fact that cash destroys your purchasing power in the long term, in the near term, that destruction is an option premium. Having cash will give you the courage and the tools to take advantage of volatility as opposed to being taken advantage of.